Sameer, good morning. Thank you for joining us. Two strategies, I guess, which everybody is trying to contemplate. First, this market will hit a new high and stay there. Second, the best is behind us in the short term and markets will consolidate or fall. Which camp do you belong to?
Morning, Nikunj. I think firstly, let us understand what has happened last week was definitely tectonic in terms of this was the hard bullet that nobody expected the government to bite, and they moved how? It was done so quickly. Even against the DTC recommendations of 25%, we've actually brought it down to 22. So it's a great move. Now, what has happened in the last 3 days is that suddenly the so-called animal spirits have definitely been unleashed. Today, corporate India thinks that yes, the government will act and the government is serious about ensuring that the economy is back on the growth track. So those are very big positives. But having said that, we don't see that there is a lot of commitment on part of FIIs. Even in terms of the recent stock movements, wherever the effective tax rate differential has been large, for example, even within sectors, like for auto, and Eicher Motors was at 35% tax rate, whereas the M&M was at 25. So therefore, the pronounced move that you've seen in the recent 3 days in both these stocks who belong to the same sector has been very different. So the market has clearly made a differential that once the tax rate has come down, it is for good. And hence, there has been stock-wise movements within sectors. Now, whether does this lead to an increase in capex? Well, that is a function of what is my current capacity and what is my estimation of the demand that I see here on. Having said that, the monsoon has definitely been good. In fact, after 2013, India has probably seen an excess monsoon for the first time after almost 6 years. So that's a big thing. So even though the distribution may not be great, so you may not have a very big Kharif output, but at least the outlook on Rabi crop is definitely positive. So that's a big sentiment boost. And having said that, the valuations that if we roll back to say, July after the first quarter numbers, when everybody bought the earnings down 8-10%, today, because of the tax cut, you are back to the expectation of 20-25% for FY20 on the Nifty earnings. So that's where the market is back where it is. But I think from here onwards, the big mover is the September quarter earnings. Because if that somehow shows some green shoots, then people will build confidence, and I think the participation levels should start going up.
Okay, so then are you betting on the consumption theme then, Sameer, or being positive on it with the outlook that given some of those factors, we will see a revival in growth and that will positively impact these companies?
Abha, I think apart from consumption, which is fairly well owned and well valued, I think government is the big mover here. So today, when you see that the bills that were pending for long have been starting to get cleared, money is back into the system, and orders are being given out, I think you will probably see the economy facing the domestic cyclicals probably more in favor than perhaps the consumption or the FMCG. And I think apart from that, even where there has been a massive drawdown in terms of prices, like some of the state-owned banks or where the tax rate was very high, I think that is where those themes are likely to play out far better.
All right, let's take a look at some of the other stocks and focus then today. We've got that downgrade on SBI, which we've talked about, and so we will keep an eye on that one as we head into trade. 9,500 crore IDBI Bank loans up for sale. That's the kind of quantum we're looking at. So a couple of these key names that we will be tracking on opening. SBI Cap has initiated a buy on PVR as well as Inox, both those in favor. JSW, meanwhile, has launched a $400 million bond issue to fund its capex plans. We've been speaking to the management this week as well, sounding very bullish about the way ahead. And Kaveri Seed to buy back up to about 2.8 million shares. So quite a few stocks in action as we head into trade this morning. And in other stocks that we've been focusing on, we've been tracking, of course, some of the movement on the IT names. Sameer, we saw IT pharma, the defensive play, so to speak, completely lag when the markets were on fire. Yesterday, completely back in play. Not sure what to make of it.
Well, I think most of the tech space has been at 25% effective tax rate. So to that extent, to think that because of this change in the taxation, there'll be any immediate benefit, well, that will not likely to be. You've not seen any upgrades. And that's where the positive news is not forthcoming. So therefore, the optimism on Friday and Monday was perhaps not there. Yesterday, there was some sort of a tempering. So people realized that there is a lot of catch-up to be done. So in case there's likely to be a demand revival, I think it's likely to show up in these sectors as well, because IT is a large employment generation and those kind of things. I think The other thing that also plays out is that tax cut is one move, which will definitely give you some sort of a positive sentiment on a capex outline, which is a larger long-term decision for a corporate. The next thing that needs to probably be looked at in terms of a follow-up is personal tax reduction, which is where you will see a direct stimulus to the demand. And I think if you do both of these, then there's definitely likely to be some amount of fiscal strain. And because of that, one should definitely hear some positive action on the divestment front. And now, since we have only 4 months left for the fiscal to get over, I think the space for piecemeal, like CPSE, ETF, etc., that probably will not move the needle much. So one needs to look at real strategic divestments where you'll get in big money. And in case the government moves on that, quite honestly, that is what will really sort of sets the market on the right track.
Just want to address the Morgan Stanley downgrade coming in for SBI this morning, wherein they've downgraded the stock to now an equal weight with the target price of 330. They're saying that asset quality concerns still persist. Sameer, do you believe that one is safer sticking by with the private corporate names?
Well, Aisha, I think from here onwards, one has to look at what will be the improvement at the margin. And I think private banks have been fairly valued. So the asset improvement is likely to be visible in case the economy picks up in the banks which have not been priced. So that's where I think public sector banks would be a larger beneficiary of the incremental flow and the improvement in business due to a revival in the economy.
Very interesting that just yesterday, and our producer just has highlighted that the DMart shares, after the kind of move that they have seen post the tax cut coming in on Friday, the market cap has actually crossed Titans.
The tax rate for DMart comes down.
Yeah.
And I guess you would imagine that DMart ultimately is a retailer. Now, whatever tax benefits would come down, DMart could actually end up retaining that. Because DMart is not in a commodity product, or it is not in a very price sensitive business where whatever tax cuts are, if they're not able to retain, if they are not able to pass it on, they actually will, the competition...
they don't have to pass through, basically.
So it will actually just stay with them. Now, for a company which is a very efficiently run company, if they are able to retain large part of the cash earnings, then they automatically will end up reducing debt. They don't have a very large debt, or they can use this for expansion. So in both the ways, I think DMart is in a very sweet spot. If it was a steel company, a commodity company, any other company which does not lack pricing power, whatever tax cuts are, they'll have to pass it on because the competition will also do in that case. So in this case, this will hit the bottom line directly, or this will help the debt reduction or the capex expansion.
Yeah, it's a win-win for all corners when it comes to DMart, really. Within consumption, Sameer, where is the opportunity to buy afresh? Because anything from a Titan to a DMart to an Asian Paints, they're all trading at exuberant valuations.
So, Aisha, I think here incremental flow will be perhaps not that high as where in bigger returns are likely to be made where ownership is low and the delta is likely to be bigger. So yes,
for the longest time I've heard fund managers, they always come on forums and they say buy something which is new, buy something where ownership is low, buy something which is not discovered, buy something unknown. But the classic compounder in last 10 years, in last 15 years has been HDFC Bank, which is well owned, well discovered and is owned by foreigners. Asian Paints, well owned, well discovered, owned by institutional
investors. And at
investors.
every level it's looked expensive.
Which is the point. I'm saying that whereas there is if you are able to identify a multi-bagger, nothing like it. But not every stock will become a multi-bagger. And in a quest to find multi-bagger, what I've realized a lot of time, investors, both institutional and retail and HNI investors, they end up buying rubbish. Sometimes you need to buy simple compounding stories. Over ownership, under ownership, these are important factors. But they cannot be the only factor. Just because HDFC Bank is owned, why should you not buy it?
Because you have a point there. The essence that I was trying to mention was that these are franchisee companies. All the names that you mentioned, HDFC Bank, Titan, all these are franchisees. Now, franchise value is a very different connotation from the classic valuation that an investor would look at. So these are stocks these are like you can make an SIP on them on a monthly basis, even on an individual case that, you can keep buying them and these will compound because that's where the demand will be there. They'll be able to run an efficient business model and there'll be returns for the investors to make. But I thought the Aisha's question was that where will be the larger flow from here onwards for investors to look at in terms of allocating capital from here on. Now, yes, I think there one should make a case of allocation to these franchisee companies which will continue on their growth path, but because of the tax rate reduction, there will not likely to be a large change in them as perhaps in some other cases where the tax rates were far higher. That's the only limited point I'm trying to make, because the tax rate reduction is a profit opportunity that is available on a permanent ongoing basis for any corporate. And I think that's where a company at 35% effective tax rate coming down to 25, that effectively means that a 10% secular earnings growth from here onwards.
So which name would you pick up?
See, for example, if you look at, say, a Coal India or Aisha Motors, I mean, these are companies where there is some element of franchise value, there is some element of competitiveness, a monopolistic situation, and I think these are places where one is likely to see a good pickup in the revenue line in case the sentiment and the economy picks up.
All right. Let's get some other picks going as well. Kunal, from the broader markets, what else is looking attractive to you?
So one of the stocks which I think just about managed to give a fresh breakout yesterday is Raymond's. The stock has not done exceptionally well in the last 3-4 days. But I think yesterday we saw first signs of strong price momentum coming back into the stock. It's still reeling below its long-term averages, the 200 and the 50-day moving averages. But I think because of yesterday's price move and the kind of volume support the stock got, I believe Raymond could head higher from current levels and even try and challenge its 200-day moving average over the course of the next couple of days. That's a buy, 612 as the target, and stop us at 580.
All right, CK, let's get some strategies from you as well. Some more to add to the list today.
Well, I think one of the stocks which really looked up very smartly yesterday was from the IT pack, and Tech Mahindra was one of them, which traded rather well. And this came as a bit of a surprise because the stock was actually threatening to go down and seemingly, tripped up some technical signals as well. Now, typically on a chart, when a bearish signal fails to deliver or fails to evoke any follow-through price action on the next bar, I think that is a signal from the market that the bearishness is not going to play out. Now, this has a double effect of having caught sellers on the wrong foot, because new buyers have suddenly, come into that stock and taken it up. So Tech Mahindra above the current levels, I think, will probably shoot up from here. And we can look at least about 15-20 rupees movement if it were to occur. A short-term stop loss can be maintained at about 690.
Okay, and Abhijit, let's take a look. What are you looking at from the broader markets?
I would recommend NBCC. After it made a low near 28 in August, where it has been rising steadily, and all the rising days it has been rising with good volumes. Right now it has a resistance near this 50-day moving average near 41, but it is a buy on all dips with a stop loss below 35, and I expect it to go towards 43, 45, which is its 100-day moving average.
Okay. Let's also tell you what's hot off the press, and here's a look at all the top headlines from the Economic Times. The first one, of course, like we've been highlighting earlier as well, SBI has approached the Securities and Exchange Board of India, or SEBI, seeking a one-time exception for mutual funds over a rule on segregation of assets so that they could be part of a resolution plan being worked on for Diwan housing. Next up, PDC India, the nation's top power trading company that seems to be in negotiations with a potential suitor to sell two subsidiaries, non-bank lender PDC India Financial Services, and of course renewable energy firm PDC Energy as well, according to sources to Economic Times. The move, it seems, is aimed at raising about 1,500 to 2,000 crore rupees, besides exiting from the non-core businesses, said one of the people, speaking on condition of anonymity. And Amazon's plan to acquire stake in Reliance Retail has likely fallen through due to the high valuation of Mukesh Ambani's retail business, and the American e-commerce giant might have also demerged from such a large investment in the Indian market after the government tightened regulations for foreign direct investment in e-commerce.
Well, just scanning through the list of stocks at a 52-week high. It's a long list. It's a very fat list. Trust me, we don't talk about some of these names on a daily basis. REITs, it's a PSU company, 263. You got Naveen Florichem, 799. Timken, almost 800 rupees. MCX, Siemens, PVR, Pfizer. Oh, long list. I'm stopping at 25 because I'll have to, my screen will take 2 more minutes to refresh it. But what I'm saying is that the market rally is just not restricted to a particular genre, quarter, segment. It's very, very broad based. MCX is an exchange. Whirlpool is a consumer durable stock. PVR is a multiplex. REITs is a PSU company. Muthoot Finance is an NBFC. And Indraprastha Gas is a utility stock. Okay? The movement in the broader market, I'm not saying it is exhilarating, but it is certainly very encouraging. The list of stocks at a 52-week high, if I compare Thursday's list versus Tuesday's data, it's very impressive.
Yes, I think, this is the money which has been waiting on the sidelines, which has suddenly come into all these stocks. If you take notice of the names that you read out, the few names that you read out, they're all at the top of their, individual sectors. You're talking about Pfizer and Muthoot and Whirlpool India and stuff like that. You're not really talking about a DHFL here or a DLF, which was down in the dumps, and people have come in and bought those things aggressively. People, like I said, this is money which was on the sidelines, and the first thing it will do when it senses an opportunity like it did right now is come into some of the leader stock which have got dropped down, or which are which have held their ground, are likely to stage an upward breakout. And this will also include illiquid stocks. For example, if you take something very illiquid like, let's say, Grindwell Norton, that's a stock which punched up to all-time new highs. Now, this clearly indicates that there was a lot of money on the sideline which was waiting to come into the market. So this is the first flush. The second flush will now spread to other stocks which have had decent numbers or managed to hold on or have some growth outlook in them. I think that is still pending to happen. And then the third flush will come into all the set of riffraffs and all that.
We're talking about mid-cap stocks and what's going on there. I want to talk about DMart, talk about Aditya Birla Retail, Trent, Shoppers Stop. These are retailers. We are talking about a disruptive global wave of e-commerce. That's here to stay. That's real. But India's most traditional brick and mortar company, which is DMart, is now commanding a market cap of 1 lakh crore. Trent is at a P multiple of 70 plus. 70 was at 450, now it is 500 plus, so it should be 75, 80 P multiple. Then you look at Aditya Birla Fashion Retail, the company which bought into the Pantaloon brand from the Future Group. The stock is sitting at a relatively new high, so to speak. So look at DMart, 52-week high, despite being expensive, stock is up 32%. Aditya Birla Fashion Retail, a complete proxy to consumption, is 14% higher. Okay, now let's look at consumer durable stocks. Bajaj Electricals, Whirlpool, Voltas, complete proxy to consumer demand, complete proxy to summer, complete proxy to how good you're feeling about money in your bank, or how much money you really want to spend, which may not be called as compulsive. These stocks also have done very well. So Sameer, hello. I think we are talking about slowdown, and excepting autos, the markets are telling you a completely different story.
Well, Nikunj, there's a factor of a lot of things. Like there is franchise value, there is...
Whatever it may be, these are consumer stocks, right?
Correct. But then...
And these are high P multiple stocks. And these are expensive stocks. And they are stocks which are associated with consumer demand. You feel good, that's the time you go and buy an air conditioner. You feel good, that's the time you go and shop. You feel good, that's the time you will buy a piece of garment. The companies are not slowing down, and stock prices are sitting at a record high.
Nikunj, if you look at case by case, now for most of them, the earnings have not been as high as one would have expected or liked them to be, but they have not completely fallen off the cliff either. That is one. Second, most of them are very tightly held stocks. So to that extent, those who own them have so much of faith and confidence that nobody wants to let go, even for the short term, in terms of an overvaluation which might be existing for a brief period of time. So therefore, now a stock has to, probably the price has to fall or go up when there has to be some amount of excess selling or buying which is not being met through offers. Now, those factors also play in these names. And more importantly, that all these are perhaps efficient machines where the ROEs are still good enough. So one would obviously, if one wants to have a place to hide, these are names that come up as the first list. So if I have to own stock, I can't be sitting on cash. I think these are names that present themselves with the first opportunity. So it services that criteria. The growth has not completely fallen off. And the fact that these are franchises which will have values that will compound. Now, yes, your point that if there is a slowdown concern, then this should be visible. These may probably be the last ones where you will probably see the impact of slowdown getting manifested in their numbers. Now, that's why a monsoon being okay is a big fillip for most of them, because that would mean that the base consumption will then perhaps come back faster than expected. And that's where these companies will still continue to report growth. So I think the growth disappointment has perhaps been the least in most of these names. And that's the reason why ownership has held on and hence the prices have maintained or perhaps gone up.
Kunal, on the charts though, what is it that you're seeing if you track any of these, the Voltas, Whirlpool, etc.?
So I think Voltas is doing exceptionally well. So after that, 2 years of sideways range, it's come out, quite well in the last 2-3 days. In fact, the stock needed a bit of a push or a trigger in terms of news. And I think after this news, the way the stock has broken out, it just about indicates that this 2 years of lull is now, over for the stock and it's ready for, a big breakout. The other stocks which you mentioned, I think even Havells as well, the last 2-3 days has shown a very good chart pattern, and it's typical because when you generally see a breakout, we talk about that buy on dips is a very good strategy, but the stock actually gave you that kind of a dip from 750-55 levels. It actually came back to 700-710 levels. It touched its 200 moving average. So that was a classic sign of a mean reversion process getting over. So I believe both on short-term charts as well as on longer-term charts, both Havells and Voltas look exceptionally well.
CK? These stocks are not feeling the heat, let me put it this way. Whether it's Voltas, Whirlpool, or for that matter, any air conditioning company.
Maybe that's why.
They're not feeling the heat.
We have to see it from two angles. How much have they depreciated already? Number one. Number two, what has been the recent trends in terms of, the numbers? Because when the prices are significantly down, people try to find solace wherever they can see them. And as far as stocks are concerned, or stocks with some degree of pedigree from the past are concerned, I think the numbers do give comfort. And taking Voltas as a specific example, I think, Voltas surprised us by showing the kind of growth in AC sales, etc. I think 30-35% kind of growth in the last quarter. I think that really surprised the market. So, I think there is a differentiation which the market makes progressively when it's caught in a downtrend. So across the 20-month fall that we had, I think stocks which started to exhibit some amount of resilience as far as their numbers were concerned, I think these stocks stopped falling and some amount of fresh buying came in. They were all nibbling at it, not really going aggressive, but that helped these stocks to, stave off the decline. And I would definitely put Voltas among those names, and there are several more such. Now, people have aggressively gone after, the DMarts of the world, but the Voltases of the world have also survived the bearish pressure. And I think they are the ones which will now start moving up, because the money flow, when the second flush comes, will all go into such names.
3.5 minutes to go, and then we'll get the first pre-open rates. Let's look at crude. Crude has stabilized. Crude has stabilized, which is very, very important for us to point out. The only chink in the armor, or if I may use the word fly in the ointment, is why are FIs not buying? I mean, what is wrong? Foreign institutional investors have got just about everything what they wanted in terms of a clear direction from the government. For me, the way I look at the current move by the government, and it is not just on the tax, on the fact that they heard out foreign institutional investors and removed and rolled back the FBI tax. It just tells you that they're using the political goodwill, and they are not afraid from being called a suit boot ki sarkar. Let me put it this way. The first criticism which comes by the opposition is, guys, what's going on? Where is the Aam Aadmi angle in it? If you're doing corporate tax cut, it has to go to the corporates, not to the Aam Aadmi. But your political mandate is so strong, you can easily use your goodwill to bring down tax. And the second way you can thread the needle, I think it's disinvestment. What Sameer was saying. We are not talking about it because PSU stocks are not widely well respected and owned. But look at the move in BPCL. 3 days, the chunky move which has come in BPCL, it's nothing short of exemplary, and that is just telling you that markets have started to believe that this government will be able to monetize some of their old cash guzzling assets like Air India and maybe strategic assets like BPCL. Will you buy BPCL with this view? Or for that matter, any PSUs thinking that tomorrow will be better for these PSUs?
Well, Nikunj, I think our view on OMCs has always been good because they are fantastically run businesses available at great value. Now, that also means that these are great assets for somebody to chase them. Now, we've heard of BPCL, even HPCL for that matter. I think if these stocks see the light of divestments someday in some form strategically, the amount of windfall that it can unlock for the government is tremendous. And more importantly, I think the entire re-rating, for example, HP is available at 6 times EV/EBITDA. Now, I think these are companies which are fantastic cash machines. The petrol price deregulation mechanism is seamless. We've seen the recent week also, the prices have been marked up appreciably. So there is no reason for somebody not to go in for them, especially when the entire auto sector, auto fuel retailing story in India is just about to be unleashed. So I think PSUs as a basket have a strong chance that there is cash flow, there is enough appetite on the part of investors. The moment a government shows commitment, which I think they have after this recent tax cut move, so today the believers that yes, the government may perhaps go ahead and make that strategic divestment before the financial year runs out is far higher than what it was, say, a month back. So I think these are great prices available at great value, and in case the trigger of divestment also is a good tailwind, I think these stocks can be primed for a good run.
What are you observing on the charts for not just OMCs? I know we've been talking about BPCL for long, but any other PSU which is actually looking strong to you?
So I think a couple of the PSU names which look fairly attractive, the likes of BEML, which is now not in FNO. Now the stock is extremely volatile in terms of the price trend, but when you look at the holistic price patterns, especially over the last 1 to 2 years, the stock is trying to form a very interesting higher high, higher low kind of a pattern, and every time the stock sees a sharp correction, it's been countered exactly like a V-shaped recovery. It comes back quite strongly, manages to make a new short-term swing high, and I think that's the sign of a strength building up to the stock price. So just because of that high beta nature, it becomes very difficult to try and take a short-term oriented call. But if you're a positional player, I believe a breakout is in the offing on a longer-term charts as well. The other stock which I believe is also looking exceptionally well is BEL, Bharat Electric. I think even that stock over the last 1 year approximately has been making a inverse head and shoulder pattern, and generally such kind of a patterns spread across a longer term time frame have more impact into the stock price trend. So I believe BEL, which is just about very close to that big breakout of 112, 115 range, I think anytime the stock crosses those levels as well on longer term charts, it could provide a very strong upside.
Just want to focus on a couple of other names as well. First, the pre-open rates, much in line with what the SGX is indicating, another quiet start for us. Just want to see what SBI is up to after that Morgan Stanley downgrade coming in. 9,500 crore rupees IDBI bank loans are up for sale. So that's going to be another story to look out for. SBI Cap has initiated a buy on PVR in Inox. Stocks already at pretty much life highs. JSW has launched a $400 million bond issue to fund their further capex requirement. And Kaveri Seed is looking to buy back about almost 28 million shares. So look out for that stack as well. Typically, a buyback tends to excite the stock prices. Besides that, Infosys, of course, has been pretty active. We've been tracking this story very closely. L&T. And Sameer, many believe that investment is the way to go as opposed to consumption if you had to really pick out between them. You think L&T is the best bet here?
Aisha, L&T would be a beneficiary in case the capex and the government tendering starts. And I think that is the belief now, that government is the big mover now, because and government has shown the will and the commitment to act. So I think now the move forward is that you will see much bigger tendering going on in terms of the infrastructure spend out, and I think that is where the order book accretion to L&T should then pick up, and that is what perhaps the street is pricing and or expecting rather. And I think that is where one would like to see as to how do the September quarter commentary say in terms of have there been any orders that have been tendered out, and what's the thing on the various state governments.
Group and lenders have agreed on timeline extension. Sorry for the interruption, Sameer. Need to mark this. Now, SL Group and lenders have agreed on timeline extension. This is about the Z stock. The Z stock has been on a downward spiral because after the stock or the debt crisis which hit the SL Group in the month of Jan, the lenders and SL Group, they entered into a agreement where lenders had given the Z Group or the SL Group timeline to meet their debt obligations. They've tried their bit to meet, but they've not been able to repay the entire entire mutual fund industry per se by selling the 10% stake to Oppenheimer. The fear in the market was that lenders may not decide to extend their lifeline or extend their agreement, and some mutual funds, without getting into specific names, have decided to reduce their exposure to Z. The stock has been suffering, but now what we understand that lenders have unanimously agreed to extend their timeline. The details are something which we don't know. I mean, we'll try and see if we can get a representation, let's say from Kotak or Birla, because those are the large lenders. But this is important. The stock today will rally. It's a good morning for them.
Absolutely. I think it's a business that is in good shape. It is just that today, because of this huge overhang as to what is likely to happen in terms of how the promoters will settle their debt and the stake sale and the discussions with the MFs, I think that is what is creating a short-term overhang. And if that clarity starts getting more comforting, I think the stock can perhaps retrace earlier levels, because at 30,000 crores, honestly, it's not a bad business and a bad situation in case the economy was to pick up from here.
You'll buy Z stock, that means.
At this price, it's a fairly good risk-reward equation.
How are you mapping the price? Why is it good? Why is it bad? Just because it's fallen, or you think it's become cheap?
No, because see, the whole argument
OTT platform is losing money.
Pardon me?
The OTT platform Z5 is losing money.
Yes, but the fact is it was not expected to make money from day one anyway. So when businesses and verticals are in investment mode, there is a certain amount of runway that you give them for them to play out. And I think in terms of how the accretion has been, the content creation, etc., I think there is enough for us to give them some time. And this overhang has perhaps seen a very disproportionate amount of price impact on the stock price. So that's why I said at 30,000 crores, it's not a very bad risk-reward equation, given the fact that the business doesn't seem to have completely fallen off the cliff.
Okay.
Okay.